Hi Digital Chiefs, welcome back. Today we're going to look at the 5 biggest mistakes I've seen when startup founders are pitching investors. So the first one is not understanding the role of the investor. What does that mean? To be honest, I actually made this mistake when I was pitching investors, and I see this all the time with founders. Let's look at the Investopedia description of what an investor is. So an investor is any person or entity who commits capital with the expectation of receiving financial returns. i.e., the goal of an investor is to make money, a financial return. This fact is true regardless of you pitching a high net worth angel investor or a venture capital fund, as well as a corporate venture capital fund. If you're looking to understand a little bit more about the nuances between these 3 kind of investors, I recommend you check out my other video here. Investors are in a deal to make money. Please make sure you understand this when you are cold emailing investors, as well as when you're speaking to investors. What does this mean to you as a startup founder? Well, have a look at your pitch deck, have a look at your emails to investors. Does it have a basic aha moment where the investor's thinking, hey, there's some money to be made here? It does not need to be in your face, but it does need to be some sort of subtle stream to allow the investor to connect your particular business with the opportunity to make money. I find that founders usually get very wrapped up in the product features and not really talking enough about, is there potential for someone to pay for this product? What is the demand for this? What is the problem you're trying to solve? And end of the day, is there someone willing to pay for the problem to go away? Now, the investor might actually gain other benefits by investing in your business. It could be reputational. It could be research and development related. It could be anything to do with impact and some sort of positive community contribution. However, end of the day though, they are still seeking some sort of financial return. They are not donors and they are not philanthropists. So please keep that in mind. They are looking for some sort of tangible return. So have a look at your pitch deck. Have a look at the way you're speaking to investors. Are there numbers in the pitch deck? Are there numbers that tell a narrative of some sort of 10x return in there? It could be 10x over 10 years. Mind you, that's really quite conservative, but they're again looking for some sort of theme that there is an opportunity to make a return on your business. The second biggest mistake I see with founders is not knowing your numbers. I see plenty of pitch decks completely omitting numbers, cold emails omitting numbers, and again, investors think in numbers. So some of the numbers that all founders should roughly know is the cost of acquisition, sometimes called a CAC, the lifetime value of a particular customer, LTV, and other things such as profit margins, what competitors might be actually paying already in the market for a similar solution. The target market size as well is really quite important. Even if you don't have some of these numbers because you're quite early in the journey, then you should be able to show perhaps what competitors are currently already doing, how are they solving the problem already for the existing customer, and what that customer is currently already paying. You can even do this via surveys with customers, asking the question, how much would you pay for this app? How much would you pay for a subscription? What would make sense for that particular customer? Showing some sort of basic understanding of what your customer is willing to pay and how long it will take to get them on board and what that potential process might be is incredibly important for an investor to understand how will you make money and how will they eventually get a return. Naturally, the later you are, the more numbers you'll have from your business, such as churn rates, your burn rate, your growth rates, your engagement rates, your user growth rates. There are a lot of numbers in there. If you want me to break down the various common numbers and terms that you should know, then let me know in the comments. The easier you make it for the investor to actually see the narrative clearly on how to make a 10x return, the sooner you'll get responses back from investors and the more interest you'll have. So the third most common mistake I see is startup founders really just treating the entire relationship with an investor like a transaction, i.e. typically asking for just money but no other help. So let's be honest, investors really don't like to be treated like a cash slot machine. We prefer to really be able to deliver value in addition to money. I'm sure most of you have heard the term smart money when it comes to raising capital. Well, I suppose ask yourself, is there anyone who wants to be dumb money? So keep that in mind. How can you really hone in on the right type of investors for you? And the money should ideally be part of a huge bonus that you also attain when you have this particular strategic investor involved. Focusing just on the money is not particularly helpful, given that there are so many deals also out there for many investors, and they can really pick and choose. And for them to be a lot more interested are usually deals that they can invest money and also be able to provide other support such as their network or certain advice, certain expertise. The investor and startup founder relationship is typically not a transaction. It takes 7 to 10 years for an exit. That means it's very much a journey and a relationship. Ideally, your investor comes back and reinvests as well and connects you to other investors. If you've taken my startup fundraising course, you'll know that you should actually spend quite a bit of time understanding, researching an investor, targeting the most strategic investors for you. And in that way, you can actually naturally treat it not just like a transaction. Another key point to consider is that you can't actually fire your investors. So for those of you who spend a lot of time hiring talent, you will go through a process of vetting that particular employee. With an employee, you can obviously let them go, but unlike an investor, you can't actually just fire them. So it should be equally important for you to build the relationship with the investor before you take on their capital. Founders that really go ahead and pitch the most strategic investors and ask for more than just money really show that they're quite sophisticated. They understand that money is not the only thing that matters in terms of building a successful company. You need good advice, you need great employees, and you really need the right expertise and the network to unblock some of the roadblocks. So it's really important for a founder to understand that money isn't the only thing that is going to make a business successful. Otherwise, a corporate who has plenty of cash would always beat a startup, and obviously that's not the case. Now, I will caveat this one thing. If you are asking for more than just capital, perhaps it's introductions, perhaps it's helping you vet a new hire, looking for other strategic board members, any of those things are perfectly okay. The one key thing though I will flag is to perhaps not ask for is introductions to other investors until you've got some sort of key commitment from this particular investor to invest. The reason for this is that investors typically won't do other introductions to other investors unless they're actually investing, or they've said no to the investment because of it's not the right sector for them, it's not the right size of investment. If they've already said no, but then they're happy to make other introductions and offer to do that, then that's perfectly okay. But I would not start off with the very first meeting asking for other introductions to other investors straight away, because it shows, one, a little bit of desperation. Secondly, it also very quickly demonstrates that hey, you're actually not wanting this particular strategic investor on board. It's perfectly okay to do that after perhaps the second or third meeting. By then, the investor's probably a little bit interested if they're already spending time with you, but I would stay away from asking for connections to other investors straight off after the first meeting. Active investors will always get a lot of emails in their inbox, And many of them will just not be in our sector because the founders actually not done much research. We've said no straight away, and then they tend to reply with asking for an introduction to an investor. And the fact is, we get a lot of these emails. It's very hard for us to be able to, one, reply to them, and secondly, refer you to anyone. We simply wouldn't be able to have time to actually invest and vet deals that we are interested in. So the fourth common mistake I see, I sort of touched on it in the previous point, not really knowing much about your particular investor, i.e. where are they based, what's their expertise, what's their interest area, what's their check size, what is really the sector they like to work in and invest in. This is similar to having a target market for your actual investor. For example, if you are running a business selling women's clothing, but you are not looking to really sell to men, except you've sent out an email to customers regardless of their age, their demographic, their gender, their location. You've really done no research on your market, and therefore you're just sending it out to everybody. I see this in startup founders where they're really spraying and praying. They've got an investor list somehow and they're just sending it out to everybody. Very, very unlikely that you'll get an investor meeting that way. Most of the time you'll just put your email address into the spam box, and really it doesn't show that you're committed to understanding business development. I'm not going to go into too much detail around how to do research on your investor. I do have a 3-hour startup fundraising workshop. The links are in the comments below. So the stronger the connection between your particular business and the investor's expertise and network, the more likely you'll be able to get meetings and then eventually that check. It sounds like a lot of work you have to do to raise capital. Well, the fact is, it is. It takes 6 to 12 months to raise a round, and much of the time you are doing it practically full time. The fifth and final mistake that I see quite frequently is not actually following up with the investor. So you've done all the hard work, you've done research on the investor, you've finally sat down with them, and then you've had a really good meeting and there were a list of items that you both were meant to follow up on. Commonly, I don't see founders actually proactively following up. They're not replying and saying, thank you so much for your time. These are things that I actually said I'd do, and I'll come back to you on these by this certain time frame that you might have agreed on. It's really similar to if you've gone for an interview and you've actually not sent them an email saying thank you, except there's additional action items on there. So making sure that you're there to build the relationship. Investors are vetting from day one. They look at your emails, your cold email pitches, and your pitch deck. When they sit down with you, they're assessing you and doing a quote unquote interview, then looking at how you follow up. Do you actually do what you say you're going to do? Do you actually respond to them with the answers that you said you would? Most investors know they're investing for 7 to 10 years. They're trying to figure out if they can actually work with you over the longer term. And if you're not even sitting down and saying thank you after you've had the meeting, responding to questions they had that they felt were important, providing links and information, if they've volunteered to actually do introductions for you and you've actually not sent them any information to be able to forward on, all of this is not ideal. You want to do all of that within 24 hours, 48 hours at most, and then any follow-up questions if you need extended time, no more than a week out. Again, fundraising is a huge commitment. You do need to be ready and make sure the momentum keeps going from as soon as you start emailing that particular investor. So hopefully this gives you a few things to think about. If you're not really making these mistakes, then you are already pitching better than I'd say 70% of startup founders out there. If you want me to break down any of the particular themes a bit more, such as how to vet an investor, what particular numbers are important at what stage, feel free to leave me a comment below. Happy fundraising!